Okay, good morning, everybody. I'm David Yermack. I'm the moderator for today's symposium on the topic of DeFi on Ethereum. This has really emerged as one of the most interesting and important areas in crypto. And it's a real treat today. We have two of the very top researchers in the area, Will Song from Cornell, Alfred Lehar from Calgary. We have an hour and a half, so we'll have 45 minutes set aside for each paper. And we intend to have as much discussion and Q&A as possible. So we encourage people to use the Q&A function or to raise your hand, and each speaker will pause several times for questions. So by agreement, will go first, and the floor is yours.
Thank you, David, for the kind introduction and hosting the session. And thanks to the organizers for the session. So what I hope to share with you all today is a work in progress, a working paper that I have with Tang at Tsinghua University and Yanxin, Wang, and Zhao at Jiaotong University. Most of the empirical work, including the hosting of the large volumes of data, done at Jiaotong University. And my co-author Yanxin is actually with us today as well. So as you can see from the title, we have financial inclusion and democratization in the title. So that's going to be our major theme. We want to take an initial investigation of the Ethereum ecosystem and actually make three kind of intuitive contributions in this space. The first one is very straightforward. It's just gathering the data and presenting a description of the basic trends in the ecosystem, as well as the distribution of mining income, distribution of token ownership, which includes both the Ether token, ETH, as well as other ERC20 tokens built on top of the Ethereum platform. We'll also talk about distributions of transactions. And this should give us a basic idea of kind of how equal or how active different users within the ecosystem are. And then we'll zoom in to talk more about transactions, not only the distribution of transaction fees, but the mechanism, the design of transaction fees, or the use of gas within the ecosystem. And from that, we actually document that the current design is not very conducive to financial inclusion or financial democratization. What we have in mind for inclusion and democratization are really, are the activities equally distributed within the network, poorer and poorer agents or agents with smaller transactions facing more hurdles to transact within the network. Is the failure rate really high? If a payment network or smart contracting network has high failure rates, that's not very inclusive because it's not even functional in some sense. But not all hope is lost. The third part of the paper is about some changes introduced to the transaction fee mechanism or other programs within the ecosystem, including the EIP 1559 change that happened together with the London hard fork, as well as various airdropping programs. And what we want to bring in or discuss is how these actions or these changes are really redistributive. They are redistributive monetary policy that's going to allocate or move some wealth from the wealthier groups or more active groups to the less active groups. And as a consequence, you'll see they actually promote or facilitate inclusion in the sense that smaller players or poorer players, based on their on-chain wealth, are going to become more active in the network. So we want to speak to a few literature. This is definitely related to transaction fee mechanisms in the blockchain-based system. And one of our organizers, Fahad, also has a recent paper looking more at the fees of decentralized exchanges. And here we're just going to look at fees in the Ethereum network. Why do we focus on the Ethereum network? In terms of number of DeFi projects or protocols it covers, it's over 93%. In terms of volume, it's also over 60%. So it's definitely very representative of the DeFi space. And there are more and more other Web3 applications coming into the space as well. And just related to that, we drawing a number of studies looking at the impact of EIP 1559 fee mechanism change, as well as various applications of DeFi. In particular, we want to provide a initial description, information, and benchmark for looking at Ethereum network. There are earlier studies looking at, for example, Bitcoin payment network by, for example, Antoinette and Igor. So we are adding to that discussion for sure. And more broadly, our study is related to research on digitization, transaction costs, and financial inclusion. That's not necessarily about crypto, but about inclusion, financial inclusion, and digitization in general. So let me spend a minute on the data that we use. We actually download all transaction information from Ethereum by running a Ethereum node. So we actually have over 3 billion transactions. Now, not all of them are externally initiated. There are some transactions that are triggered by smart contracts. But even after we exclude that, the externally initiated transactions, basically user-initiated transactions, still constitute to over 1.5 billion transactions for sure, and almost 2 billion transactions in the space. That's on-chain data. We also obtain data regarding block information, the address of block verifier, block number, so on and so forth. We also need to find the associated addresses on the blockchain that's linked to dApps. For that, we scrape public addresses and classification information from third-party websites or aggregators such as dApp Radar or dApp Online, Etherscan, so on and so forth. dApp Radar would classify various applications into 9 different groups. I'm going to show you a picture that includes DeFi applications, games, marketplaces, social apps. And in our sample, a total of 166 DeFi applications and 2,820 dApps are covered and recognized. That's not the full space, but it's fairly representative of the overall space. And on-chain data does not provide any initiation time of the transaction and the expected gas prices, recommended gas prices. So we get that from eastgasstation.info at every 10-minute interval, covering the sample period from February 2nd to March 2nd in 2021, just for that part of the analysis. And finally, we get historical market information from Cong market cap that covers both Ether and other ERC20 tokens. That also include trading volume, market cap, so on and so forth. And to measure popularity as a control variable, we also obtain information from Google search. That's pretty much the data set we have. As you can see, it definitely involves a large volume of data and also different data sources. So one contribution we hope to make through this study is to bring this to the public and also share among all researchers. So and in terms of computation, this is actually quite expensive. To generate the table in our study, typically, with a memory of 1T and over 500 core processors, it still takes multiple weeks to generate pictures. So hopefully, we can process and organize the data and share with researchers in the community. And just to give you an initial glimpse into the data sharing platform that we're working on, I can quickly share a live version where you can map out all the nodes within the ecosystem that includes dApps, users, different type of transactions within smart contracts or across users, so on and so forth. Just as an illustration. So let me switch back to my slides here. So let me jump into the basic description. Within the Ethereum ecosystem, we have two types of players, essentially, right? One category of agents are the users, and they might own a node or an account themselves that will be classified as externally owned accounts, EOA. They manage that using a private key. They could also be using smart contracts, and the smart contracts would also correspond to a type of account within the ecosystem. And once the states of the system changes, certain transactions are automatically executed through those smart contracts. Those are not governed by private keys. Those are governed by the codes written into the smart contract. And the two categories of agents mainly interact through paying transaction fees. Basically, the users have to pay fees in order for the miners. Nowadays, we've switched to proof of stake, so it's different. It used to be mining activities, and the miners have to provide record keeping actions or service within the network. And for the users to specify the fees, they would indicate how much gas what's the limit of the gas amount that they are willing to pay, and what price they would set per unit of gas, and that's going to result in some cap of total gas value they are willing to pay, and the actual transaction will result in a actual amount of gas used. If the gas amount used is below that reserved amount, then the transaction can go through. If it exceeds, typically we experience a transaction failure. So that's very different from Bitcoin, where it's still a bidding process, but it's just a fee that people indicate, and then whoever has the highest win. What that implies is, in Bitcoin network, you never have a transaction failure. You might have a transaction that's delayed indefinitely to be included in the chain of blocks, whereas in Ethereum, certain transactions can fail just because you don't have enough reserve of gas, or there are some errors in the codes of the smart contract. In terms of the distribution of mining income, this slide contains quite a bit of information, but what we are really trying to plot is in the top panel is the kind of percentile of mining nodes. That includes mining pools as well, and what percentage of the mining rewards are they getting. And the yellow color is just the total rewards they're getting. And you should read off the right vertical axis for that. So it's not exceeding 100%. But for the distribution of mining income, we have essentially 5% of the top nodes, essentially 3 to 5 mining pools, are receiving over 60% of the rewards. And the top 5% of individual miners are also receiving over 70% of all the mining income. Is this very concentrated? It does look very concentrated. Is it worse than the income distribution or wealth distribution in the physical world, in the real economy? Not necessarily. And this is comparable actually with the distribution that we observe in the Bitcoin network. Now, one thing we can't quite claim when we come to the token ownership is, well, we actually don't observe the rest of the portfolio of the nodes. So the statement has to be qualified. This is about online income distribution and on-chain income distribution and on-chain wealth distribution. Now, in the lower panel, I'm basically showing the percentile of the nodes, individual miner nodes, and the percentage of mining income that they have in terms of the shares. What we did is we can start with a mining pool, and that's what you see in this tracing process figure. At the very top, the figure is too small. You may not be able to see it, but there are gold-colored dots. Those are mining pools, and you can trace that to the members of that mining pool, and then you can trace multiple layers of transactions. The first layer of transaction of that individual mining node, and the second layer, so on and so forth. But even after tracing that, we still see concentration in mining income. Now, in terms of token ownership, what we observe in this figure is exchanges and large DeFi or DApp nodes are dominating space in terms of holding of ETH token. And vast majority, over 90% in circulation are held by contract accounts and exchange addresses, and only 5% are held by individual users, and top 0.1% of users own more than 50% of all the wealth. Again, that's comparable to what we observe in the Bitcoin payment network. It does indicate some uneven distribution in the system. And finally, if we look at the distribution of transactions, what I'm showing you here in the top left panel is the share of ETH transactions versus other ERC20 token transactions in the Ethereum network. And we can see over time, other ERC20 top layer application tokens are becoming more dominant relatively. And the right panel are just showing different categories of transactions and activities. And what we observe is peer-to-peer transactions have decreased. That's what we observe in the middle, kind of a brownish color. And what has increased are transactions among the app nodes and transactions among nodes associated with DeFi protocols. So we definitely see an increase. And the lower left panel is just showing kind of in terms of level, how the transaction volume has been evolving over time. And we see towards the end of our sample 2020, early 2021, it has been increasing a bit more. Now, there's a lot more we observe in the network. In the interest of time, I probably wouldn't be able to go into the details. But what we're showing in this picture are basically you can plot various DApps and DeFi protocols, how much activity they have in terms of the amount of Ethereum being paid, so on and so forth, which one is playing a more central role. And the lower left panel is showing you basically each dot is a DApp or DeFi protocol. The size will be the amount of activities there are, and the sphere, locations on the sphere will be the distribution of users. So you can see different categories of the apps indicated by different colors, how close they are to one another. That could indicate a form of competition. And if it's larger, it's covering more user nodes as well. And you can look at layer 1 ETH transactions, ERC20 token transactions, as well as smart contract interactions, all within the space. The bottom right panel is just showing an example of Uniswap, right, as a DApp, and all the user nodes. And I think this yellow dot is probably a exchange node that's having a lot of connections with that. That's
Well,
pretty
do
much.
we have
Yes.
time for a question or two?
Yes, please. Yeah.
And I have to say, this reminds me of the arrival of the Hubble telescope. And for the first, it's like a trip to the planetarium. It's fascinating. Thomas Rivera has a question, and I'm going to unmute you, Thomas. So please go ahead.
Yeah.
I will. Thanks, David. So yeah, I was just wondering if you see this increase in mining income concentration. So has it gotten better or worse? I mean, what do you think it's gotten better or worse since the shift to proof of stake?
Right. That's a great question. So our data actually don't cover the episode after the merge, But in principle, even though the protocol for consensus generation has changed, the fee mechanism is not necessarily very different. Of course, we expect to see the emergence of a block building market and all that. But so far, we don't have much information on it. Within our sample, though, when you look at, do I have that figure? Yes. So the lower left panel is showing the Herfindahl index for the externally owned accounts within Ethereum. So what we see is originally it was very concentrated because very few people were in the ecosystem. And then more and more people join, so the concentration decreases. But towards the end of our sample, concentration starts to accumulate again. So at least within our sample, we see increasing trend of concentration. But we don't have much to say about post-merge situation. But that'll be interesting to look into. The data are all public. It just takes time to obtain.
All right, thanks.
Yeah, thanks for the question. So let me just move on to focus on the transaction fee mechanism and link that to inclusion and democratization. So the idea is actually very intuitive. If the execution of smart contracts takes about the same number of steps, whether I'm transferring $50 versus $5 million, then the fees are essentially representing a fixed cost. Now, for a small player or someone who's transacting very small amount, I'm buying a cup of coffee, the fee I have to pay could be hundreds of the transaction amount. Whereas for someone transferring $5 million typically through international banking system, this could be very cheap. So in a sense, it's helping large players a lot, not so much for the smaller players. One thing we can look at is just the percentage transaction fee, right? The fees as a percentage of the value of the transaction. And here, the very first volume, I'm showing you the transaction amount, right? If I'm and this is in dollar value. We know sometimes we try a small amount before we make a large amount transaction. So some of that is contributing to these smaller value categories. But in general, what we observe is the larger the amount of transaction you have, the smaller percentage as of the total value transacted is your actual gas fee paid or used. So that doesn't sound very inclusive. That's essentially saying, small players and players with lower balance within the network may not benefit as much from the ecosystem. And in fact, you can show, and actually previous studies also document this, there's significant negative relationship between the gas price and the delay time, basically by paying more. It's not only about whether I'm paying a higher percentage. It's also about the time it takes for my transaction to go through in the system. We can't claim anything causal here, but what we did is we use previous day information, which people can download from the blockchain to predict the delay time and output variables for the next day. And what we observe is network utilization is definitely positively predicting the gas price for the next period. At least there's strong correlation in this space. So what that means is when the system is more congested, people are paying more, not too surprisingly. And if I'm paying more just for the transaction of a cup of coffee, I'm probably not going to use this network. I probably go back to my bank account or credit cards. And for those unbanked population, this would also be a hurdle for them to join the network. And in the last bullet point here, I indicated impact on the ERC20 tokens are larger than that on user transactions. What I mean is the payment made in ETH is the time delay is less affected by the gas price. Maybe I shouldn't use the word affected. It's less negatively correlated with the gas price than other ERC20 tokens within the network. And remember, the users have to set a gas reserve fee. And if they don't set it correctly, that's going to lead to transaction failures as well. So what we observe is there's a positive correlation between larger gas price or larger transaction value and network congestion measures, such as utilization rate, with the amount of reserve people are setting. Right? If I'm setting a high gas price, so my transaction value is larger, or the network congestion is greater, people are setting a higher gas reserve. Nothing surprising, right? We would expect that to happen, but the exercise is to quantify that to figure out what's the correlation in that space. So it's definitely quite positively correlated, and we also have some information on transaction failures. There are 4 major types of transaction failures. Auto gas is just we are not setting enough reserve, right, in the gas fee. Therefore, the transaction cannot be completed. Reverted is basically what you write in a smart contract that would stop a transaction. Conditions are not met, transactions are stopped. So that will be reverted. Bad instruction entails problems in the operation logic of the transaction execution, right? For example, in crowdfunding, once you reach the all or nothing threshold, excess funds wouldn't be accepted, right? That would be put into a bad instruction if people are still trying to add more fund to that crowdfunding project. And finally, bad jump destination is just caused by errors in the smart contract codes. As we can see, not setting enough reserve is constituting about 30% of all failures. And what is the overall failure rate? Well, overall failure rate, depending on the type of transactions, is in between 4 to 7.5% in that range. So this is not a small failure rate compared to the use of MasterCard or other type of digital transactions. So unless we bring the failure rate down, this is not good news. And remember, when we reserve the fees, it's also locking up assets into the system, and there's opportunity cost to that as well. So this is another hurdle that we have to overcome. And reserving extra gas fee is positively correlated with, the reduced probability of failure for the next day, so on and so forth. We can run a contemporaneous regression as well. We did that earlier, but what we report is in this table. I think this table is not fully updated with the data. We had data until I think Q1 last year, but now it's extended to February this year. So other tables, the earlier tables are all updated. I think this is still the earlier one. There are some links to the volatility of token returns for both ETH and ERC20 tokens. Without going into the details, basically, if the return of a particular token, expected return is higher, that's going to lead people to be more willing to transact. And if the volatility is higher, people are typically suffering from the fact that high volatility is going to trigger more transaction failures because you don't set enough reserve in the system. And that's another dimension that's problematic. I'll take a pause here as well before I move on to the third part.
Yes, we do have one question in the queue, and it is from Vada Adadarkwa. And let me unmute, just give me one moment. Vasca, please go ahead.
Thanks. That's a great presentation. So I just wanted to ask if when you're observing all these transactions happening on the nodes, are you able to trace if any funds are leaving the Ethereum ecosystem via like bridges, for example, to go to Solana or other, I guess, lower fee chains, or to the layer 2s on Ethereum? Because that could be one way to see if people are getting tired of the high fees, right?
Right. That's a great suggestion. Our current computation is not including that, but I think there are ways to trace it down. We just have to investigate that further. I don't know, Yanxin, if you have Any thoughts on that? My understanding is that you do need to, well, if those bridges are also kind of open, bridge networks or Oracle networks, that'll be easier. But if
often they create copies, right, of the token, and they lock the one. Yeah,
exactly. Yeah,
but one drawback is that you wouldn't see the people who just move from exchanges, but at least you would see the on-chain stuff.
Right. And so far, the exercise we've been doing has a heavy emphasis for on-chain information, and that will be consistent with what you are saying. For example, Antoinette and Igor's paper for Bitcoin payment network, they actually spent a lot of effort to map kind of offline IDs of the nodes. I think that's an interesting exercise for Ethereum as well. That's not something we are doing in this study. But I think as an initial benchmark, there's already a lot of information for us to.
No, for sure.
Thanks.
Thanks very much.
We also have a question from Rod Garrett.
Yes.
Yeah. Just on that point, I was going to mention that there is a paper by Chinea and Liu, who are graduate students at UCSB that I supervise that show in fact that there are large value transactions in liquidity pools are typically done on Ethereum, and small value transactions are done on Solana on the layer 2 solution, but the fees are cheaper. So it reinforces these points.
Yeah, definitely. I'll definitely look into that paper, and I think we start to see more and more evidence and patterns that will be consistent with this kind of hurdle to inclusion. Thanks, Rob.
Okay, and Matthias Hafner.
Yes, hi, thank you very much for the presentation. I just wonder, well, one thing is like all the blockchains, but another possibility is to also look at the credit card and other digital payment solutions where there are some data available as well. Have you looked at that, if there are some substitution patterns, or is that or not?
Yeah, so that's a great direction to go into. I think for reporting some aggregate statistics, such as distribution patterns, and do a comparison, that's something we can do. To link the wallets to the accounts in other payment networks, that's fairly challenging. So I think my conjecture will be we can't do too much there, and unless you are in a Scandinavian country where you see the whole portfolio holding. But I believe that survey ended in 2007, so it's right before the birth of Bitcoin. So I'm not sure how much crypto they would cover. It'll be interesting to be able to link these accounts.
Sure, thanks.
Yeah,
Well,
thanks.
I wanted to ask, are you
Yes.
surprised how many people run out of gas? And do you think there's a strategic aspect that people are trying to like put through transactions only if they're cheap enough to execute, that kind of thing? Or are they just incompetent about calculating the mining?
Right.
fee?
In the paper, we kind of made a remark that it's about education. Many of the transactions by retail investors, small players, they don't have a good prediction on the gas price reserve needed. So that's why they don't put down the right number. But what you suggested, I think, is totally valid, and that's something we should discuss. Which one is going to dominate? I'm trying to see if there's a way to see that in the data. Presumably, larger players are more institutional driven and sophisticated.
Yeah, you can maybe look at the history of, maybe someone runs out of gas when they're new, but not so much after they get some experience, because you can identify repeat players, right?
Yeah.
So we have one more question from my colleague, Hannah Haliberta. Go ahead, Hannah.
Hi, Will. Great presentation, great paper. So for running out of gas, I know that a lot of people who are using, who are transacting, they are using wallets that are suggesting them the gas that they should put out. And I think that some of those wallets are just using outdated information about the gas price, and this is why they are not putting enough of gas units. So this is something that may be happening, like again, sophisticated, unsophisticated. But I think there may be another explanation that you may look at. So what we know is that if the sender of the transaction puts too many gas units, not too high of a gas price, but too many gas units, whatever is not used in transaction goes back to the sender. Right. So it should be always a great strategy to just put a lot of gas units, because whatever is unused comes back to me. But if I put too little, then the transaction eats up my gas and doesn't go through. But I think that then you need to put out a lot of capital and freeze it for the time of the transaction, and this will hurt smaller senders, smaller users much more than larger users.
Right, absolutely. So we'll definitely incorporate these comments, and also on that last point, it does depend on their opportunity cost, and presumably, well, actually, I actually don't have a conclusive guess on whether smaller players or larger players will have a higher opportunity cost of the capital, but that's something we should discuss as well. Thank you.
Okay, thanks for all the questions. Will, we have about 7 minutes.
Okay, great. I think we should be able to finish these slides. The third part is about how some of the changes actually move the whole ecosystem towards greater inclusion. And we know changes are still ongoing, right, with the merge with other phenomena within the ecosystem. So one of them is EIP 1559. EIP 1559 happened as part of the Lehar fork. It went live on August 5th, 2021. It wasn't pre-announced. It was announced, oh, we're about to do this, but the exact date wasn't clear to the users. And EIP 1559 includes several changes related to the fee mechanism. One of them is some of the transaction fees are going to be burned. Base fees are going to be collected and they are going to be burned. The structure is a deviation from first price auction, right? So it's definitely related to the design of transaction fees. And there are other components to the change, such as you can set a maximum priority fee per gas. That's the tip that users are willing to pay the miners, whereas max fee per gas is the maximum gas price users are willing to bear. They also double the block size, so on and so forth. One thing we can utilize from that change is the fee burning mechanism. So we know burning fees are sending the tokens to invalid addresses, whatever, right? Just taking circulation tokens out of circulation. It's a so-called deflationary action. Presumably, if the demand remains about the same, token value should go up. So it's benefiting all token holders. But who's paying these burned fees? Well, we were saying large players are paying, they are the most active, so they are paying a lot of fees, and part of that is burned. In that sense, it's a redistribution in terms of token monetary policy within the ecosystem. So I want to look at around the implementation of EIP 1559, how mining income and transaction activities would change for users of different balance level or different income share prior to the 1559. That's the basic idea. And if we do that, right, what we can do is we can look at 10 weeks before, 10 weeks after. We can also exclude a week very close to August 5th in case people were anticipating the change to be implemented, or excluding 2 weeks as a way to strengthen the identification a bit more. And what we see overall is there's negative effect on mining income. Not too surprising, some of the mining income is burned. But what's interesting is that users or miners belonging to larger mining pools, they suffered less from this decrease. And miners with higher computation power, the ones that were earning higher income, suffered more. And that can be seen from the interaction term. Here I use long percent of blocks. That's just the percentage share of blocks mined by the mining pool you belong to. So this is positive. That means if you belong to a larger mining pool, your income actually suffer less in terms of the decrease due to EIP 1559. And the second line here, second row here is logarithm of the rewards you were receiving in terms of percentage. So if you were a high income miner, you actually suffer more. And as we can tell from the negative coefficients here. And the left panel is just showing a picture of pre-trend and what happens afterward. That's on the mining side, right? Mining income. What about the usage of the network? Overall, we see a positive effect on transaction volume and the number of DFs used. That's something we are not providing a detailed mechanism because there are multiple reasons why this could happen. But we do want to look at the heterogeneity of this change. So for, let me see if I have that. For users with lower transaction frequency and less Ethereum balance before the EIP 1559, they actually had more activities, relatively speaking. So here, before indicates before EIP 1559, transaction is just the transaction frequency, balance is your balance. So the more active you were, the richer you were earlier, the less increase in transaction activities you experience. And in fact, sometimes you experience a decrease in transaction activities, whereas the poorer and less active nodes experience a larger increase in terms of transaction activities. And it's in that sense that this could be inclusive. That's one type of redistributive action. Another type would be airdropping. And I've seen maybe 2-3 studies on airdropping. Overall, we haven't looked into that quite a bit, partially because we believe it's just a marketing attempt, but it's actually representative of a redistributive monetary policy in the sense that when we airdrop tokens, we're typically minting new tokens that increases supply and it hurts all token holders. Who's benefiting? Whoever is receiving the airdrop. So it's a redistribution of wealth, at least in a relative sense in the system. And what we look at is the airdrop by Omisco that happened back in 2017 from over 11 days, September 13th to September 23rd. The program ran in the following way. There was a snapshot for July 7th in the same year. By the way, that was the first large-scale airdrop, and Omisco is a payment network I think originally in the Southeast Asian region, but now has gone more global. So what they do is they look at your ETH holding. If it's above 0.1 at that point in time, you'll get allocated OMG token proportionally to your balance, to the extent that your holding or the distribution of holding of Ether is not fully correlated with the wealth level of holding OMG. There's some reshuffling of wealth. And we utilize that. Basically, when you see airdrop would indicate treatment after means the date of the treatment. What you can see is the ones receiving the treated group, receiving OMGs, they increase their transaction activities within the Ethereum ecosystem. What is even more interesting is that in terms of the price impact on ETH and on the OMG tokens, when you give people OMG, holders of Ether, when you give them OMG, you are essentially encouraging them to use an alternative currency within the cyberspace rather than Ether. There could be a negative effect on Ether price, but at the same time, the ecosystem is growing. So what we observe is that the overall positive effect dominates. When you construct the synthetic price of ETH post the treatment, post the introduction of airdropping of OMG tokens, you actually see price increases in ETH. So I think I'm right on time, so I'm going to stop here. Basically, we just want to provide initial sources of information and benchmark within the Ethereum ecosystem so that we can start to talk more about inclusion, democratization, distribution of income and wealth within this very representative DeFi and Web3 platform. Thank you.
Okay, thank you very much, Will. And there's one question in the Q&A that your co-author Yanxin would like to take. So Yanxin, if I could ask you to unmute and perhaps read the question as well.
Okay, well, I think this question is actually not a question. It's just we might ask that another function of the gas limit citing.
Yeah, that's right. Why do we set a limit on gas? That's to prevent certain hacking activities, right? If I don't set a limit and there's a loophole in the smart contract, people could really lose a lot. So it's a safety measure, absolutely. So that's a remark from Xavier.
Yeah. Okay. So thank you, and I think we should now move on to the second presentation by Alfred Lehar. Thank you very much, Will.
Thank you.
Okay, thank you very much, and thank you so much to the organizers for inviting me. This is joint work with Christine Parlour from UC Berkeley, and we're going to talk about systemic fragility in decentralized markets. So we've done a lot of work on, as a profession, on contagion and systemic risk in banking and mainstream financial markets, but there's very little work that has been done in DeFi markets. And given the recent events of crisis in crypto, this is more interesting to look at what can emanate from these decentralized networks and how much risk can this cause to the system. So why is it interesting to look at DeFi? Well, we have some unique characteristics for DeFi markets, like that capital can move freely, that there is some innovative mechanisms like flash loans to overcome capital constraint. We also have a closed form informational system. Everything is on chain, so we can really trace what people are doing, what wallet addresses are doing, and what they are trading. And also we have no regulators, so there's no circuit breakers, no lenders of last resort, so we can really see what's going to happen, how are things going to unfold in this world where there is no safeguards. So collateralized lending is the second largest DeFi application, so the numbers have probably come down a little bit, but there's a lot of money locked up in various DeFi lending protocols. We're going to focus on two very large ones, so that's Aave and Compound. And we, in our paper, hope to convince you that we have systemic fragility in these lending platforms. Specifically, we want to look at negative feedback loops when there is under-collateralized loans that get liquidated, and the collateral then very often gets sold immediately on a decentralized exchange. So that creates some downward price pressure on the value of that collateral. As the collateral becomes worth less, more loans are under-collateralized, so more loans get liquidated, and that creates more price pressure on the collateral, and we can see this kind of whole thing unfold in a bad way. So let me start with some institutional features of this market. So we have these lending platforms, for example, Aave, that give out collateralized loans. So here in this example, the borrower posts 11 wrapped ETH as collateral, and this is fine as long as the value of the collateral is greater than the amount being borrowed. So here we have a factor kappa that captures this. Kappa is greater than 1, and very often the precise ratio depends on what kind of collateral you have, what kind of debt you have, and which platform you're on, but very often this is about 1.2. So we have 20% over collateralization in these markets. So in in our example, the borrower borrowed a Bitcoin against the collateral of 11 wrapped ETH. So in many ways, this is similar to the repo market or to margin trading that we see in traditional finance. So what happens when this collateral value is now decreased? So let's assume that this 11 wrapped ETH is now worth less than 1.2 times 1 Bitcoin. So that means the loan is under collateralized. It's still kind of the value of the collateral still exceeds the amount of the loan, but it's not 120 times the amount of the loan anymore. So something like 110 or something like this to think about. So what happens? So in a traditional bank, the bank would liquidate the position, or if I do margin trading, the broker would liquidate my position. So here in DeFi, we have a different setup where liquidators, private liquidators come in. And so as soon as they see that the loan is insufficiently collateralized, pretty much anybody on the internet can liquidate the loan. So what do these liquidators do? They have to repay the loan, and in return, they get the collateral of the loan. So what happens if, for example, the liquidator then doesn't have enough money or enough capital to repay the loan? So to repay the loan, the liquidator needs a Bitcoin. Here, what if that liquidator doesn't have the Bitcoin? Then you can go to somebody, it's called a flash lender, where you borrow a Bitcoin for an instant of time. Specifically, you just borrow that Bitcoin for this very liquidation transaction, so that you can borrow this without any collateral. And that's a very unique feature of DeFi, because all the transactions on a blockchain are atomic. That means either the whole transaction goes through or the transaction fails. And so the borrow of the Bitcoin from the flash lender only happens when also the repay happens. If I try to borrow and I cannot repay, then my transaction fails, as we'll just showed us, and then we add one of these failed transactions on the blockchain. So to make this work, we can borrow a Bitcoin from a flash lender, use that Bitcoin to repay the loan. If we repay the loan, we obtain the collateral. So that goes to the liquidator, but now the liquidator has to repay the flash lender a Bitcoin. So what do? So you go and take some of that collateral to a decentralized exchange. They can swap it into Bitcoin, and then you use that Bitcoin to repay the flash loan. So we are fine with the flash loan. And hopefully, if everything is done correctly, then the liquidator can keep a profit here to make this liquidation profitable as an incentive for the liquidator to do that. So maybe let me just stop here for a second to see if there's any questions on the institutional setup of these loan liquidations.
Yeah, I have a couple questions, and I've used some of these examples in the classroom. One thing that comes up is the flash loans seem to have no budget constraint. Like, you can be a very small person, but borrow literally hundreds of millions of dollars. Is there any risk or cause for concern there?
No, there's absolutely no risk for the flash lender, because the way an Ethereum transaction is structured is that you group a bunch of steps into one transaction, and then either the whole transaction goes through or the whole transaction fails. So it cannot be that a transaction gets partially executed. So therefore, if I put the first step in the transaction is that I borrow money, and the last step in the transaction is that I repay the flash loan. So therefore, since the whole transaction can only go through in one piece, it cannot happen that I borrow and never repay.
Yeah, I think the technology is straightforward enough, but the real risk is that if someone wants to borrow $500 million, just for an instant, they probably have something nefarious in mind. What would you do with that much money?
Yeah, that's probably true. Yeah, but there's no safeguards on what you do
Nope.
with the flash loans. And usually these flash loan providers are the large pools of capital in that ecosystem. So these are the liquidity pools, the Uniswap liquidity pools, or the DYDX pools.
But you or I could go out after lunch and borrow $500 million if we were.
Yeah, but before we could order lunch, we would have to repay them. So
Yeah.
we cannot really do anything in the real world with that money. So
the other question I wanted to pursue a little bit is that to the extent that you've had problems with this technology, it's come from people manipulating the prices of the assets and throwing that kappa constraint out of whack without any knowledge or warning to the borrower. These so-called oracle attacks that have occurred off the chain, but you get someone who can borrow $500 million and sabotage someone's loan, and there have been all kinds of these things that have led to what to me look like disastrous exploits. People don't want to call them hacks because the platforms actually work as designed, but it seems to be a vulnerability that is not part of your diagram, and really what the participant in the market needs to worry about.
Yes, absolutely. So these exploits do happen. They try to make these oracles a little bit smarter by introducing some time delay, so that you need a little bit of time to update the oracle price so that you cannot do it within one transaction and manipulate the price within the transaction. So all you need is essentially that you need to delay these oracle attacks by a few transactions or maybe a few blocks, and then this kind of short-term oracle attack with flash loans is ruled out. There's probably a lot of other ways to manipulate oracles, and that is happening. But we've seen that traders in traditional markets manipulate prices too, right? So if you think just about the LIBOR market that was manipulated. So this idea that you can strategically manipulate the price to your advantage is not new to DeFi.
Yeah, nothing new. Okay. I'm not seeing any other questions at this point, so why don't you continue on with the presentation?
Great, thank you. Okay, so what we want to show and what I want to convince you today is that if there is some kind of price effect that comes from these liquidations, it takes some time for these oracles to update. That means that more loans are under collateralized, and which leads to more liquidations, which causes a larger price effect and so on. So we are in this negative kind of feedback loop. So to look at the data, we collect loan liquidations of these two protocols between 2018 and May of 22. So we have about 42,000 liquidations in 37 collateral tokens, 41 debt tokens, and about $2.4 billion worth of loan liquidations. So now, having said that, the average liquidation is quite small. We have only about $64,000 for the average loan, and the median is even smaller at $3,500. So the largest loan liquidation in our sample was $50 million. So we also collect data on token trades on a bunch of decentralized exchanges. So there's Uniswap and SushiSwap being the two largest ones, but we also look at 6 other clones of Uniswap that follow a similar type model. So let me first show you a little bit about what are the most popular token pairs. So we have here very often some cryptocurrency, Ether, Bitcoin, paired with a US dollar stablecoin. So, and that is kind of consistent with the stylized fact, or this idea that you read very often about in various DeFi forums, that people build levered positions in ETH or in other cryptos for using these lenders. So that's kind of the idea of buying ETH on margin or buying Bitcoin on margin that we see here in these lending platforms. So there have been several talks on this forum about decentralized exchanges. So, and what is very nice about this is that we do can observe the price impact. So these liquidity pools work that you have some kind of amount of ETH and token in that liquidity pool, and that puts you on the red dot here. And if the liquidator comes in and sells some tokens to the liquidity pool, then the amount of tokens goes increases in the pool. And so we can solve graphically here by looking at the y-axis how many ETH you would get in return. And if you move from the red dot to the blue dot on the bonding curve, then you can also observe the change in the price. And the price is always the ratio of ETH to token. So, and as we sell more token, we can see that the price goes down. So this picture shows you pretty much most of what we want to say in this paper by the means of one example. So we have on May 19th, 21, we have a liquidation wave of 180 link tokens. And so you can see here in the gray part in the background how much in loans was liquidated, and that would go with the left axis. So we can see that there was kind of a little bit of a liquidation, and then to start it off, then there was some kind of smaller amounts, and then this huge wave unfolds where you see a lot of tokens being liquidated. What we see in the colored graphs is that the price of the link token on various dexes. So we see, for example, Sushi Swap in blue. Most of the liquidations in this example, the collateral was sold on Sushi Swap, but we also see Uniswap in orange here. And what we see is that as this liquidation wave unfolds, the price of the collateral goes down a lot. And so, and then stays low after this liquidation wave. There's two interesting things here. First of all, we see that this does not only affect Sushi Swap, where most of the loans collateral was liquidated, but this affects also other exchanges like Uniswap, for example, where we see a roughly equal decrease in the price. But it also affects off-chain market. So no single collateral was sold on Binance, which is the green line, but we still see that there is a significant and pretty instant price decrease in Binance. And so Binance is off-chain. It's not even possible to sell the collateral quickly in this off-chain market because you have to send it to the exchange and wait for it to be recognized there before you can trade it. So that's time delays and things like that. So no collateral was sold on Binance, but we still see this kind of spillover effect to traditional financial markets. And so this really shows you contagion across exchanges, but also outside of the blockchain. And very often I get into this discussion when I talk about decentralized exchanges where price discovery happens, whether this, and a lot of people think that price discovery happens uniquely on these centralized exchanges, and then kind of the decentralized exchanges just follow along, and there's really not anything going on there. So this is a case where the price discovery or the news event was clearly an on-chain event, and the prices started to move on the decentralized exchanges, and then Binance was the follower because there was no collateral being sold on Binance. So we see that price discovery can happen on DEXs too. And the last interesting thing we see in this graph is that we can really trace how much of that price decrease goes to the direct sale of collateral on these DEXs. So the red line shows us what would have happened to the price if all these that comes from the part that these liquidators sell that collateral on Sushi Swap. So here's the devolvement of the price if you only count those trades where the liquidators sell collateral. And we see that first, a lot of this price drop is driven by this, or is perfectly explained by these liquidations on Sushi Swap, where these loan liquidators sell the collateral. If apparently at some point in time, other people started to buy the link token, but if it was only up for the liquidators, the price would have dropped much more. and would have gone down even more. But at some point in time, there were offsetting forces where somebody else then stepped in and bought up that collateral. And so we don't see the price decrease as much as if it was only up for these loan liquidators. So we look at loan liquidation waves. So we call a liquidation part of a wave if it occurs within the hour after previous liquidation, and we find about 1,000 loan liquidations that have at least 1,000 waves that have at least 5 liquidations. So in these liquidation waves, about 27,000 loans were liquidated, and a lot of these liquidations actually really occur within larger waves where we have at least 20 loan liquidations. Our biggest wave was for over 1,000 loans. The average wave lasted about 2 hours, and the interesting question is why do these waves occur? And it seems that a lot of tokens have similar liquidation thresholds. So a lot of these loans have similar liquidation thresholds, and this could be from the past history of asset prices, that there is a cluster of vaults that have similar liquidation thresholds, and then as the price moves, a lot of these loans get liquidated. So here's a picture of these liquidation waves in blue. And what we see is that very often these liquidations coincide with large drops in ETH, but not always. So the price of ETH is here, the red line. So let me now slowly take you through a bunch of facts about these loan liquidations and how the sale of the collateral affects the asset price. So here's an example of a liquidation of $20 million worth of Bitcoin collateral on February 23rd and 21. And so you see here exactly where the collateral was sold. It was sold on SushiSwap, so that's the orange line. So we see this huge drop in the price of SushiSwap. So this was an 8% drop in the price that can be directly traced back to the sale of that collateral. Now, what happens to the price on the other exchanges? There was initially no movement because the collateral was sold on SushiSwap, and then arbitrageurs come in and see that there's a huge price difference between Uniswap and SushiSwap, so they start arbitraging away this price difference, and we see that the prices slowly converge after that. But what is interesting is that the price of Bitcoin stays lower for a little while here after the loan was liquidated. And if we know that these more sophisticated oracles that try to avoid this price manipulation, if they need time to update, then this is now the opportunity for these price oracles to update. So we see in the medium term here about a 2.4% decrease in the price of the collateral. And that's just enough to probably push other loans to be under collateralized and push them into liquidation. So this regression here shows you the 5-block return of various loan liquidations, and we look at the return of the liquidating swap and say how much does the liquidating swap explain about how the price of that collateral is going to evolve within the next 5 blocks. So 5 blocks is long enough that an arbitrageur comes in and takes away that price difference. And if our initial expectation was that there's not much that we would see here, because this is clearly a large liquidity trade. There's no real fundamental news we learn about the token other than somebody's loan, Bob's loan, was under collateralized and got liquidated, but that's not a fundamental news about Bitcoin or what Bitcoin is doing. So what we had expected was that the price would revert very quickly to where it was before, but that does not seem to be the case. So that we see that these liquidating swaps have a significant explanatory power over for the block for the price over the next 5 blocks, and not only on the exchange where the loan was liquidated, but also on other exchanges where the loan was not liquidated. So we see kind of the spillover effects of these loan liquidations to the other exchanges. Now this price impact is larger when the gas price is high, probably because it's more costly for arbitrageurs to come in and undo the large movement in the price, or to take advantage of price differences between different decentralized exchanges. But we do see clear evidence of these loan liquidations to have some kind of short-term price impact, but also to have contagion to other exchanges. And that is the important part, because these oracles, or the better oracles, at least not only use pricing data from one exchange, but use pricing data from many exchanges. And so it is important that we see these contagion effects for these oracles to update. And now we can see that as the oracles adjust their prices, that more loans are under collateralized. So this picture shows you the price impact around the whole liquidation wave. So what you see here in the negative numbers is the time before the liquidation wave unfolds. Then we leave out the liquidation wave, and from time 0 onwards, we plot the token returns after the liquidation wave is done. And what you see is that the prices have been declining before the liquidation wave unfolds, but then we do see that the price stays low after the liquidation wave. So the blue line is here our average, and the orange parts are the confidence bands around this average. So we see a significant price drop in the liquidation wave, and that price drop seems to be persistent for a while after the liquidation wave. So here we look at the liquidation return throughout the wave in a regression analysis. So we look at, again, how much does the liquidating swap here contribute to the overall return throughout the wave. And we see that the liquidating swap is not at all significant here in columns 3 and 4 if we have a single loan liquidation. So if there's a single loan liquidation, then then this is more like a liquidity trade, then the price, the liquidation gets quickly absorbed in the market, and the arbitrageurs bring back the price to where it was before. So this liquidating swap has no influence. But if there is multiple liquidations, we see that these liquidating swaps do have a significant explanatory power of the token return throughout the wave. So do these liquidations matter for other traders? And so here we look at 5-minute token returns in cases where there was a liquidation in this 5-minute interval versus there was no liquidation. And we choose kind of 5-minute intervals so that we do capture these instances where just before the or just around these liquidation waves, or maybe even within the liquidation wave, where the price just goes down, or where there's some news events around these liquidation waves. But we really isolate the effect of these long liquidations within kind of that news cycle. And so what we do see is that these liquidations create fat tails, and that we have more extreme returns that are associated with these liquidations. And that really creates, again, some kind of a spillover effect for ordinary investors in these tokens, because if you're not at all in the lending market and you're not aware of where everybody's collateralization ratio is, then you could still see here, an instance where you're exposed to this extreme risk that come from these DeFi lending activities, even though you probably just want to hold the token as an ordinary investor. Let me probably pause here for a little bit before I go into the last part of my presentation to see if there's any questions.
Yeah, we do not have any in the queue, but if anyone would like to raise hands at this point, we'd be happy to take questions. Okay, so we have two. First, Gordon. Please go ahead, Gordon.
I'm curious to hear your thoughts. Have you seen any kind of front running of liquidation, given that everything is out in the open with on-chain data, that people observe there are liquidation threshold and people kind of front run that liquidation by pulling out early? And, allegedly said that.
Yeah, so people can, of course, liquidate. The rational thing to do would be to liquidate yourself before you hit the liquidation threshold, right? So because then you at least get the surplus of the loan liquidation. So in theory, if everybody was behaving fully rational, we should not see any loan liquidations, because for any borrower, it would be better to, as you approach the threshold, to do this same transaction that I just showed before with the flash swap yourself, without being liquidated by the market. At least then you get the surplus. So in these loan liquidations, and I'll show you some evidence, we do see that these bots are very active in this space, and they are actively competing for these loan liquidations. So this is a sophisticated market where you of course want to be first. And in the companion paper we have on MEV, we document that a lot of these loan liquidations come from bots that seem to somehow jump the queue by signing up with an interface like Flash bots or something like this to jump the queue and be first for the loan liquidation.
Yeah, I didn't mean the bot liquidation from running in the MEV sense, more just generally, given that people can observe where the liquidation could occur, that kind of investors pull out by selling their stake early. And your point about if you're rational, then you should be liquidating yourself, that definitely makes sense, except I think a lot of the constraints are actually because the 24/7 nature of crypto, that people might not be necessarily paying attention.
I think there's dedicated service protocols that you can use that would liquidate your own loan. So there is DeFi private sector solutions for this, but we have not looked at the efficiency of these protocols yet.
Thank you so much.
Okay, Matthias.
Oops, sorry. So yeah, super interesting presentation as well. So I'm just wondering, I guess the magnitude of the price impact is strongly related by how much of the assets are locked as a collateral versus the available liquidity in, I guess, decentralized exchanges. So did you also look at that relation, how basically the liquidity or that ratio influences the price impact in the end?
Yes, for sure. Yeah, so that is absolutely true. So in the average liquidation wave, about 1% of the DEX liquidity gets liquidated, and the large waves, about 11% of DEX liquidity gets liquidated. And for sure, the size of the tokens liquidity pools make a difference. And that is correct, but again, it's an endogenous choice how big these liquidity pools are, and it's also endogenous which kind of collateral token you post as collateral. And if you know that your token is very illiquid, you might not want to use that as collateral, right? So to understand that, we need to have some deeper thoughts about how this liquidity is being allocated and how the decision for collateral is being made.
Okay. And
Yeah,
Peter Mueller.
How is this fundamentally different than a short squeeze in a traditional margin market?
I don't think it's really a short squeeze, because I don't really need to buy back any tokens. And there's all of a sudden nobody wants to sell to me. So I don't think that there's any fundamental change in the liquidity around these loan liquidation events. So it's not that the liquidity decreases in these pools around the loan around liquidation waves. So I think in that sense, we have very liquid trading markets where you can just go and buy. And the second thing is that this is done by private outside liquidators, right? So this is not somebody who's trying to cover their own short position. This is just somebody on the outside who liquidates existing loans. So in that sense, I think there's some differences here. There's certainly also some similarities that you have an open position that you're trying to close. So in that sense, there's some similarity there. But I think it's the whole institutional setup is very different.
Thank you.
Okay, let's continue then, Alfred. We have 9 or 10 minutes.
Okay, perfect. So we do look at these liquidators a little bit, and so we observe about 1,000 different liquidators in this market, but this is very concentrated. The top 20 liquidators perform about half of the liquidations and liquidate 3/4 of the collateral. So if you look at a picture of these top 20 liquidators and about how much collateral they liquidate, we see that these this is again very highly concentrated, so where the top liquidators liquidate a very big part of the collateral. And there's specifically one liquidator outstanding that's very active. So these liquidators are also often specialized. So we look here at Aave in blue and Compound in orange, and we see that these liquidators sometimes specialize in one protocol. The liquidator number 2 does both. For example, but a lot of these liquidators just focus on one kind of lending protocol, which leads us to think that there's some kind of specialization in this market that you want to be, that this is technically sophisticated and that you want to focus on the intricate details of a specific protocol. So what we want to test next is some kind of a regression that explains when are swaps being used, because these liquidators don't necessarily have to sell the collateral immediately. You could also just keep the collateral and just keep it as an asset if you have enough capital and you don't need a flash loan. So then you don't need to really sell the collateral. You could potentially keep it. So what drives the choice of the liquidator, whether they want to immediately sell the collateral or keep it? And so one factor that we observe is that the amount of the loan liquidation plays an important role here. So if you liquidate a large loan with a large amount of collateral, then you want to sell that immediately. And that's consistent with the idea that these liquidators don't want to have the price risk by holding on to a large amount of collateral, or they just don't have the capital and they require a flash loan. And if you need a flash loan, then you need to swap to repay the flash loan. So the size of the loan liquidation is important. What we also see is that these these swaps are correlated with large and short liquidation waves. And here the causality is a little bit unclear, because it could be that either in these large and short waves, you want to trade very quickly to not be exposed to any price risk, or it could be that because these loan liquidators turn around and sell the collateral immediately, that's what makes the wave larger and also faster to unravel, because that puts down the price pressure and that causes more loan liquidations. So we cannot really pin down the causality here, but there is clear correlation between the size and wavelength here and the usage of swaps. So the last thing I would like to show you is that there is, of course, potential for predatory liquidations. And we have not done a complete analysis, but I can give you some anecdotal evidence here. So in May 21, 147 loans with red Bitcoin as collateral were liquidated. So there's about $64 million. And what we want to do is we want to trace the trades of these liquidators before the start of the liquidation wave. So if you are one of these large liquidators and you see that there's a bunch of loans at the edge of liquidation, you might as well give them a little push and push down the collateral price on purpose so that you can then go liquidate these loans and make money from that. So we look at the wallets of these liquidators and we look at their aggregate position. So here is again a similar picture than you've seen before. So in gray is the amount of collateral that has been liquidated, and in orange we see the price of the collateral token, and in blue, what is new, we see the position of these liquidators in the collateral. So, and we also go back, so the liquidation wave starts here at time 0, and we go back before the start of the liquidation wave. And what we see is that these liquidators go short about $500,000 worth of collateral, and that we cannot show the causality of that, but at least in that same time, we see the collateral price going down. And then these liquidators stay kind of short until the liquidation wave comes into full swing, and we see a massive collapse in the collateral price. But once we see that the collateral has tanked, what these liquidators do is they actually start buying the collateral. And so they strategically purchase the collateral here as it's going to bounce back to the previous price. So we see that these liquidators act very strategically, not only in taking advantage of the profits that they can get from liquidating the loans, but also they actively push the loans into default before the liquidation wave unfolds. And then when the prices are depressed, they strategically buy these tokens, these collateral tokens, as the price comes back up. So what I hope to convince you today is that there is systemic fragility in these DeFi markets. So we have feedback loops, and I hope that we have some robust evidence to really document the existence and how these feedback loops work in detail. This is not just limited and does not create only a problem for the DeFi lending market. This also affects the whole return distribution of assets. And I think this is going to be interesting because as we move more to with CBDCs and more links with the traditional financial markets, it could be that these risks emanating from these DeFi protocols also manifest themselves in traditional financial markets. And this really is a source of systemic risk going forward. So, thank you.
Thank you very much. We have time for 1 or 2 questions, and we have another one from Vasca. So let me unmute. Please go ahead.
Yeah, perfect. It was a very interesting presentation. Thanks very much. I was wondering about if you examined how the introduction of flash loans on Ethereum would have impacted how easy it is to create a contagion, or whether it would have reduced that propensity. Because as far as I'm aware, I've introduced flash loans in 2020. So when MakerDAO was created, there wouldn't have been any unless people had a manual way to create them.
So the first flash loans actually predate that. So I don't recall exactly when the first flash loan was made, but that was quite a bit earlier. And one of the large flash loan providers is DYDX. And then it was Uniswap with version 2 that allowed flash loans. And Aave was kind of a little bit late in the game. So we do have, for most of our sample periods, we do have flash loans being in existence from other providers. So I think it's hard to identify these kind of.
So it's not possible. Cool, thanks.
You're welcome.
Okay, we're at the end of our time. I'd like to thank both speakers.